Hi, I'm Slade Robertson. I'm the Managing Director at Devon Funds Management, and it is my pleasure today to be here with Patrick Washer, who is the Portfolio Manager for the Devon Dividend Yield Fund. So Patrick, would you mind running us through what the details around the Devon Dividend Yield strategy and what your objectives are with it?
Yeah, thanks, Slade. So we have effectively a dual mandate here where we run the retail product, which I'm invested in, alongside a larger wholesale product. And what we're trying to achieve here is a dividend yield around 2% above the underlying benchmark. So that typically is in the 5% range. And we have quarterly distributions of this. We'd also really like, and we focus a lot on with regards to our portfolio composition, to generate the dividend yield which grows above CPI over the next 3 years. So this is focusing on companies which generate sustainable growing dividends that are funded from cash flow rather than debt, for instance. On the other side of the ledger, we also try to have pleasing absolute performance outcomes. These are largely funded from our focus on defensive companies where we don't take undue risk on the downside in regards to capital preservation, but that's kind of how we think about the dual mandate.
Oh, that's great. I guess one of the other luxuries that you have with this particular strategy is the ability to allocate capital across both New Zealand and Australia. How do you think about that decision?
Yeah. So I think it's a superpower in some respect that we have a bigger pool of investments. Our TAM and our total addressable universe is, say, 200, 300 companies feasibly across Australasia. And what we try to do, in New Zealand we have the benefits of company-derived imputation credits, and our REITs are structured in pies, which are much more tax efficient. However, New Zealand is a smaller market, and in Australia it's a larger pool, and there's, at certain times, better growth options for investors. So we see opportunities, for instance, with defensive telco companies, challenger telcos, which have really strong growth prospects, which we can't access in, say, New Zealand Spark. And that larger opportunity set allows us in Aussie to have slightly better growth outcomes, perhaps, balanced against New Zealand, where we have better tax-efficient dividend streams. So you'd tend to expect that the portfolio is, we have a benchmark of 50-50 NZ-Aussie, and at present, it's symptomatic of general positioning. There's around 40% in Australia. So quite a diversified outcome across the Trans-Tasman.
Right. Mate, there's a lot going on in the world at the moment, both in terms of economic cycle, in terms of geopolitics, policy settings. When we think about what the return outcomes could be at this stage of the cycle, what should we be thinking of?
Yeah, so inherently the dividend yield product is a more defensive, lower beta return stream. So we have large positions in property, infrastructure, communication services type businesses. These inherently should endure smaller drawdowns than the broader index. So if the index falls by 10%, say, you'd expect the fund to experience smaller drawdowns. Equally, that works on the reverse. So if markets really rally quite strongly in a short period of time, the fund will likely not keep up. You'd still expect a positive return, however, you wouldn't expect world-beating returns that you'd see from, say, some tech-focused funds. So inherently, it's quite a defensive posture within the companies we own. However, we're quite confident that with some really good security selection, we can still achieve really quite strong absolute returns through the cycle.
That's great. Look, it's been great for me to observe how you've gone this year over the past 12 months. The returns you've generated for the investors in this strategy have been fantastic. Can you talk to us about some of the highlights over the past 12 months?
Yeah, so it's been great, and I'd like to say that I have all my own personal liquid net wealth invested in the product alongside our investors, so very aligned, and it's been a great outcome this year. The fund's rallied by about 17% against a underlying benchmark that's done about 8.8% over the rolling year. So some really strong outperformance there. I'd call out two different asset classes which have had really strong returns. Our local REITs here, listed real estate investment trusts in New Zealand, they've actually had their best 6-monthly return period to September in over 20 years. It's largely a function of rates coming down in New Zealand. We were galvanised and increased our positions in these funds as we saw these assets trading below replacement cost with limited new supply to come. So as rates come down, demand from renters effectively increases, and the returns for these REITs, while they were trading at large discounts to NTA, have now re-rated back towards their net asset value. So these have been really strong tailwinds for investors. Another set of assets which have done really well and something we've been really excited about as a firm is our local ports. Ports around New Zealand, we have about 13 of them. They're either wholly or partially owned by councils. Councils post-COVID are largely broke in certain respects, so they need their existing assets to either work harder and earn better returns or to be sold. Led by Port of Auckland, what we've seen is a lifting in prices and port charges around New Zealand. And pleasingly, this is correlated to better earnings outcomes, and in turn, share prices have done really well. So we own 2 ports in the fund, one being Port of Tauranga, the other Napier Port. I think Napier's up slightly over 50% on the year, and Port of Tauranga's done fairly well too, up 35% or so. So these have been really strong performers. At their peak, they were about 10% of the fund. It's a great example of what we try to find, where we've got an infrastructure stock with inherently quite defensive earnings. We have a view on earnings upside, and the valuation was also quite supportive. So that's been a really great outcome for investors in the product.
Yeah, no, it certainly has, mate. It's been wonderful to see how well you've done with it. I guess when I think about the backdrop domestically now, one of the seasons that we're going through now is what we call the AGM season, and it's a foundation or a platform for company boards and executives to talk about how their businesses are going and how the sectors are behaving. When we move through this particular period now, what is it that you're looking for?
Yeah, so it's going to be really interesting seeing, as our OCRs come down by 3% over the last year and a half or so, we're starting to see some green shoots appear in our cyclical companies. And the second largest position in the fund is a company called Freightways. Freightways, in its core, is a business-to-business parcel courier business across Australasia. And we'd hope to start to see some green shoots coming through with same customer volumes. So this is parcel volumes from the same business. We're hoping to see these start to turn positive, and that correlates with strong pricing outcomes, which lead to quite pleasing operating leverage throughout their P&L. And we're hoping that this year, we could have earnings up in the order of, say, 20%, which is added by some underutilisation in their sites. And it'll be the first real, flag in the sand in some respects for 2026 and how we're starting to see our cyclical companies perform. So it's something we're really watching closely. That update is on the 30th of October, I believe, and it's one we watch with bated breath.
Awesome. I mean, you've got some wonderful businesses in the portfolio, so good luck with this next period, and we look forward to catching up again soon.
Thanks for having me here, Slade. And if you'd like any more information on the Devon Dividend Yield Fund, feel free to inquire on our website or give us a call.